Hello everyone, welcome to the video on itemized deductions. So this is going to be an overview video to help you put this in perspective. So I'm going to pull up our tax return. We're at the irs.gov. I want you to remember what it's like to go here. We click on 1040 and then I'm going to open form 1040. So there are two main areas of deductions that we learn about on the personal return. This is page 1, which has our basic information, and page 2 with our numbers. Now, the deductions we already learned about are here at line 7. We take total income on line 6 and we minus adjustments for adjusted gross income, and we can see that they're coming from Schedule 1. So this is the major section of deductions for AGI that you already learned about right here on this Schedule 1. Now, the second set of major deductions that we're going to learn about for the individual return is the itemized deductions here on line 8. So remember, you get to take the standard deduction, which are these standard amounts based on the filing status, or if your itemized deductions are greater than this amount, you get to take your itemized deductions. When someone takes itemized deductions, Schedule A must be attached to the return. So let's pull up Schedule A. We'll go back. We'll say other 1040 schedules. Oh, and here we are. This is about, let's see, Schedule A. So this is Schedule A. Now, you only attach this if the total amount of itemized deductions is greater than the standard deduction. Let's say that you only have $500 worth of itemized deductions. Maybe you have a charitable contribution for $500. You're not going to attach Schedule A because you're going to take the standard deduction of either $12,000, $24,000, or $18,000. Now, there is one situation, okay, where you might take Schedule A itemized deductions even though it's smaller than the standard deduction, and that's in the situation where you're married filing separate. Remember, I said married filing separate is not really an advantageous option to consider. Instead, it's just there to facilitate issues where people have to file separate. When a couple files married filing separate, if one couple itemizes, which is often the case, right? Often one couple will be kind of the breadwinner, and that's why you have alimony and things like this. If one of the spouses takes the itemized deductions, the other married filing separate spouse must take the itemized deductions as well, even if they have none. So they could end up losing this entire deduction because their spouse takes the itemized deductions. Okay, so let's now just like the deductions for AGI here on Schedule 1, just like all of these had their own rules and details, it's the same thing for Schedule A, okay? Now, in the past, many people were able to take the itemized deductions, and part of the Tax Cuts and Jobs Act in December of 2017 by Trump, which is now really impacting 2018, most of those changes will prevent many people from taking the Schedule A itemized deductions. There's been many changes for 2018. And unfortunately, it doesn't really simplify it. It just makes it much more difficult for people to take these. Now, I'm going to pull up the prior year Schedule A. So remember, we'll go prior year forms, and we'll type in, because there's a few big changes, and you can see them listed right on the form. So 2015 is fine. Okay, when we get to the relevant sections, I'll point those out. So, I'm going to run through these itemized deductions. I'm not going to talk about all the details. You'll read about those details in the book when you're going through chapter 5 and when you're doing the reading assignments. You'll read more about the details, but I'm going to give you an overview. Now, they do point out all of the changes because of the tax changes here at the start of the chapter. I'm going to bring those up as we cover them. So medical expenses is the first one. We can see medical and dental expenses here. Then we have taxes you paid. That's state and local taxes. Interest you paid, which is primarily mortgage interest. Gifts to charity. Casualty and theft loss. Other itemized deductions. Now, you can see here we have two main columns. We have this first column, and then we have this second column on the right. So this is where the details of our deductions go. And then after we apply a limitation at the bottom of each section here, so we have, the items listed, and then we have the bottom section which applies the limitation, then the final amount is listed in this right column, line 7, line 10, line 14, and then all of these are totaled up for the total itemized deductions here on line 17. And it says on line 18, if you elect to itemize your deductions even though they are less than your standard deduction, click here. So that's very uncommon, right? Except if you are married filing separate, or there may be some other reason why you choose to do that, and you can do that and then use your itemized deductions and attach it. But who would take less of a deduction for taxes, right? Okay. So that's an overview of the different categories. Now I'm going to really focus on the form and less on the details, and you'll read more about the details in the chapter. So medical and dental expenses. So your total amount of all of these expenses goes here on line 1. And that includes insurance, that includes long-term care insurance, and basically anything prescribed by a doctor. It does have to actually be prescribed and not just something you do for your health. You'll also read about the different people that this can be for, right? So dependents, qualified children, basically anyone in the family if you're reporting a married filing joint return. They'll talk about prescription drugs and medical. Travel and transportation can be deducted, but you're going to see that there's a very big limitation in calculating this deduction, and so it's not usually worth going through all of these details. There are two ways that you can calculate the medical expense deduction for using your automobile to travel to receive medical care. And the first is the actual cost incurred, which really just include gas for driving. It doesn't include like if your car breaks down, right? Because that's wear and tear from the car. That's not because of your one medical trip. So it's basically the actual cost of operating the car for the medical reason or the standard mileage allowance. And that's much easier, which means just using 18 cents per mile and timesing it by the number of miles you drove. Regardless, you can include parking and tolls related to the trip. Now, long-term care is basically for senior citizens or anyone who's disabled, and insurance and expenses related to that can qualify as well. And this here at the top of the page, this is what I'm going to show you on the form right now. We take our total allowable medical expenses, and then we subtract out any insurance reimbursements. That decreases the amount you paid, right? Because you effectively didn't pay if you got your money back. And that equals your allowable net medical expenses. That is the amount that goes here on line 1. Then you minus 7.5% of adjusted gross income. So remember, that's this line right above line 8, line 7, adjusted gross income. So we take 7.5% of adjusted gross income and subtract that from our total medical expenses, and that equals the amount that goes for our itemized deductions. So I'm going to show you, and it kind of follows this example you can read through here. Essentially, if someone had AGI, so line 2 here says enter the amount from form 1040 line 7, that's AGI. So if someone's going to spend $10,000 on medical, we presume they must have made $100,000, right? And line 3 here says multiply line 2 by 7.5%, so that's 7,500. So you have to have medical expenses more than 7,500 for you to get any deduction that goes in this column for your total itemized deductions. So in this situation, their $10,000 deduction turns into a $2,500 deduction. And that's how this is very limited. Okay, the next section is taxes you paid, state and local taxes. You can see here on line 5, and then they have A, B, C for different categories, and then down here they calculate a limitation. Now this limitation on taxes you paid is a new limitation, and it's preventing many people from being able to itemize that used to itemize in the past. This is the number one biggest change that is preventing people from being able to itemize their deductions. So although some of the rates did lower because of the Tax Cuts and Jobs Act changes, in many ways they made other changes that did not simplify things, that added restrictions that kind of offset the lower rates for many people anyways. Okay, so line A, state and local income taxes or general sales tax. So in Hawaii, that's basically saying you get to choose. Do you want to deduct your W-2 state income taxes that were withheld during the year? Or do you want to deduct general sales taxes that you paid, like GET tax that you pay everywhere? Well, for most people, the income tax is much easier to deduct. It's much more straightforward. There are some tables and ways of calculating sales taxes paid, but we don't get into it in this chapter. It's just we're not going to go that deep into these different categories. If you elect to use general sales tax, you check here. Otherwise, it's presumed that you use income tax. And that can be a big one. Remember, this is why if someone gets a state tax, income tax refund in the next year, they might have to include it in income if they deducted it here. Okay, and then B, state and local real estate taxes. So these can be a big one. They're the tax on your home. There's a lot going on in the news right now about people fudging their real estate value so that they can pay lower local taxes. And basically, the home is assessed at its value, and then a tax is based on that value. Those are state and local real estate taxes. C is state and local personal property taxes. So this applies to things like boats, motorcycles, things like that you're just required by the locality or the state to register. So the biggest example is your vehicle registration fees. Now, vehicle registration fees may be a fee and not a local personal property tax. It's based on, oftentimes it's only part of your vehicle registration fees that are based on the value of the vehicle. That portion that is based on the value of the vehicle, that is deductible. So in some states it's the full amount, in some states it's partial. You have to do your research, you have to look at the paperwork for when you pay your vehicle registration fees. The part that is based on the value of the vehicle, that is considered a tax, whereas any other portion is just considered a fee and is not deductible. So then on 5D, we subtotal all of these different taxes. And on line E, we enter either a flat 10,000 or 5,000 if married filing separate. Otherwise, everyone just enters 10,000. So that's a weird limitation, right? Because it applies the same to married people as single people as everyone. And then there may be some other taxes that circumvent this rule somehow. We'll see what happens this filing season. And so basically this is limited to 10,000. Now in the past, it would have been worth you getting out that vehicle registration fee, right? Because every dollar would have counted towards your itemized deductions. But now they are limiting this to $10,000. And this is really conceptually, this was always a part of taxes that really makes sense, right? Like you don't want to tax the taxes that people are paying, right? Taxing the taxes. That's a bad precedent. We don't want to do that. Now, Hawaii does that with GET quite aggressively. But regardless, federal had always tried to avoid it, with this being a major tool by which they did that. So after your basically $10,000 limitation, the maximum amount that can go on line 7 would be $10,000, or a smaller amount if your total is actually smaller. So you'll notice that the book is divided up by section. We have our state and local income tax section. They talk a bit about foreign taxes in here as well. This is that section where I was basically saying it must be based on the value. This is that in tax term and more technically explained. They talked about ownership as well here, right? Because it depends on who owns the property as far as who is required to pay the property. These examples are really great. And then they talk about documentation. This is a huge thing. Be sure to read through that. You always want to document everything. And they give some great examples down here of what you would actually have. I tell people, keep everything. Every paper related to everything. Okay, interest you paid. So here we have home mortgage interest. Now that means as long as you take out a loan to buy, build, or improve your home, just as it says right here, then the interest and any points you pay can be deductible. Now that's this whole section for line 8, right? Then we have some other sections here. Now they're saying if you didn't use all of the mortgage loan for that purpose, check here, because then you must allocate your interest and points based on the portion that you did use for that purpose and remove the portion that you did not use for that purpose. You can only deduct interest and points for a loan that you use to buy, build, or improve your home. So most people will qualify under line A. They'll receive Form 1098 from their lender reporting the total amounts that they paid, and they'll enter them here. Let's say. Now, if you have like a self-funded mortgage and the person just doesn't file the 1098, you could still fill out their information here and enter the amount you paid here. Now, there may be some situations where points aren't reported and you can enter them here. There are special rules in the instructions. Now, you'll see this on some tax forms that this line is reserved. There may be a rule that's going to come in effect soon that's scheduled for next year or something, or that they're saving that spot for. So then we add together all of these lines, and the last type of interest that we can deduct is investment interest that you paid, okay, for an investment, not for business, for an investment purpose. And if you have investment interest, essentially it's limited to the amount of investment income that you report on your Form 1040. You can only deduct up to that amount. And often you'll fill out this Form 4952, which will have the amount that you list here on that form attached. So then we get to add together 8E and 9, our mortgage interest and our any investment interest. Now you can see the Form 1098 here. Let's see. This is what a mortgage interest statement looks like. It will have the lender's information, it will have the borrower's information, and it's this total amount in box 1 that you report on Schedule A. This other information may be necessary for other calculations. Mortgage insurance premiums here on line 5, which are basically required if you don't have equity in the house of 20%. Those were deductible up until last year, but the rules got rid of those. So they used to be, I think, right here, and now they're not. And that kind of is a way to help, like, lower income people who are buying houses were the people that would be paying that amount. Okay, our next section here, gifts to charity. So if you paid a qualified organization, the organization has to be qualified. You can't just decide to give money to something that is considered charitable. The organization has to be qualified. And you can click this link here. This is an IRS website. They go through like the technical criteria for them to qualify right here. And then this link brings you to a place where you can search. And you go tax exempt organization search. And you can search the database here for a qualified organization to make sure. As long as the organization is qualified, then you can deduct contributions you made here. Now, the rules for charitable get quite complicated as well, because people can give cash, checks, right? They could make a donation, credit card, whatever, or they could give stuff like property, investments. And so the rules are different when you're giving stuff. When you're giving cash or check, as long as it's under $250, you can essentially deduct it. You need to keep your records. But if it's more than $250, you have to be getting a letter from the charitable organization confirming the amount. Each year they need to send out a letter saying the amount that you donated if you gave a one-time gift of more than $250, and telling you if it's qualified to be deducted or not, because that's based on their organization and the status of their organization. Now, if you donate property over $500 and then over $5,000, that's like a vehicle or something like that, then there's additional rules that apply, and you have to use Form 8283. So if you donate something over $500, you need to fill out this form. If you donate something over $5,000, you actually have to have an appraisal that looks at the value of the property, and you have to keep that for your records. Now, the limitation, so you see carryover from prior year, the limitation that applies for charitable contributions is basically you cannot give more than 50% of your adjusted gross income. So you cannot give more than 50% of your adjusted gross income. I'm sorry, 50% was the last year's amount and what's been effective forever. They increased that amount as part of the Tax Cuts and Jobs Act of 2017. They raised the standard limitation to 60%. So instead of 50% of your income, it's 60%. Now the thing with this is, for someone to be giving this much of their income, they obviously have a lot of assets and they have a substantial amount of income already. Just to put that in perspective. Now that's for cash and check and just giving money. When it comes to giving property and investments, there's a 30% limitation, and sometimes there's this 20% limitation that will apply. These examples are really helpful for understanding these limitations. So once you have your totals here, let's say that you gave $2,500 throughout the year, and then, and essentially for most people, right, the limitation is not going to come into effect. You're not giving away half your money. Now, if you are, you can, and you are limited by that 60% of adjusted gross income. So you can't give more than 60% of line 7. Just like we calculated 7.5 here, that would be 60,000. You can't give more than 60,000 if AGI is 100,000. But you can carry it forward to the next year to use up as much of it as you can. And then the next year, you can go forward as many as 5 years. So then here, the total amount is $7,500. Now, casualty and theft losses are another area, and it's heavily limited. It is very difficult to take a casualty and theft loss. it must be sudden in nature, it must be unexpected and unusual. If an area is declared a disaster relief, federally declared disaster area, then it can, you can take this deduction. Now this is the calculation. First, you have to look at the fair market value of the property before the event occurred, and then immediately after the event occurred. So let's say I have a house that's worth $100,000. It gets hit by some act of God that is totally unexpected and uncommon. And so the fair market value after is $20,000. Someone will only give me $20,000. Now it's destroyed. So the decline in fair market value would be the $100,000 minus the $20,000. So it would be $80,000. Now, my adjusted, we have to compare this to amount B, my adjusted basis in the property, right? If I only have, say, a $50,000 adjusted basis in the property, I can only take my adjusted basis. Select the smaller of amount A or amount B. So I can only actually lose what my investment is in the property. Which is based on what you paid and things like that. So you can only lose what you actually put in. But the reason why it's very difficult to take a deduction for even that amount is if you get insurance, you have to subtract it, and that equals the allowable loss. However, we still have to apply the limitation, which we subtract $100 per event. Okay, not too big a deal. But then we minus 10% of AGI, which is huge, right? If someone had a $100,000 AGI, this amount would be $10,000. And so that equals the deductible amount. So remember, for anything, if you get an insurance reimbursement, you can't deduct that portion because it's as if you didn't pay it. I would definitely read through some of these examples here as well. Okay, and then our last section is other itemized deductions, which I believe there's hobby losses, hobby and gambling losses, and casualty and theft of income-producing property. So you can only deduct gambling losses to the extent of gambling winnings, which are reported on Schedule 1, line 21, other income. You might remember that. And so basically we've lost out. I'll show you the older Schedule A form. We lost some big deductions here. We used to be able to deduct job expenses and miscellaneous deductions, and these could really add up. Investment expenses, like the fees that you pay to have investments. I mean, I've seen a friend who had $50,000 being deducted right here for his investment fees. So all of this is gone. Job expenses. Now, these were all difficult to take because there was a 2.5% last year. This is an older schedule. 2.5% limitation based on AGI. So that, if you're at 100,000, that would be a $2,500 limitation. So that could limit this, but it was still a pretty big deduction. Okay, guys, that's all. Then you add up your total amounts in this column, like I said, here on line 17. And if that amount is greater, it goes here on line 8. That's all for itemized deductions. Do let me know if you have any questions as you're reading through the chapter. And otherwise, I'll see you in the next video or office hours. Bye.